Right, the U.S. stock market is officially open for trade, and joining me now is Joe Brusuelas. He is the chief economist at RSM US. Joe, welcome.
Thank you.
All right, so of course the conflict in the Middle East has drawn much of the market action this week. What are the economic implications?
You know, the U.S. has a lot more runway to absorb the energy shock than really is commonly acknowledged. When we did the simulation and we took a look at how we thought this was going to impact the economy, what we saw is that you really don't get pain points until inflation's at 4%, gasoline prices are at around $4.25, and what that means is the price per barrel of oil really needs to rise to around $125 per. You know, I'm not really worried at $75, $77, even $80 a barrel on West Texas Intermediate for the path of the economy. So we're a long ways away. The real problem is in the United States. It's in the UK, the EU, China, Japan, and other countries and economies in Asia.
All right, and what should investors know when it comes to oil prices and production?
Okay, so we just produce more oil than anyone else. We're the major swing producer. I think when we see oil prices rising, what you want to begin to look at is industry, specifically food, metals, manufacturing. Those are the big three. And then you can get deep into the dive on the subsector. For example, you're probably going to see a problem in transportation due to jet fuel over in Asia quite quickly. We can already see it in the forward contracts. So I think as we turn, once we get past tomorrow's jobs report, the attention will then be focused back on that. And I wouldn't be surprised by the time Monday rolls around, the focus is going to be more on Asia than North America.
All right, and how else are the attacks on Iran impacting the energy markets?
Well, I think the natural gas market is really where you want to take a look at things. You know, Qatar has become such a vital choke point in the distribution of natural gas, specifically into Europe and the UK. You know, Italy absorbs 43% of those imports. So we're going to continue to begin to focus on whether we have another energy crisis in Europe. Although my sense is sometimes it's better to be lucky than good. We're closer to the onset of spring than we are the start of winter. And things will get better.
And Joe, how might inflation be impacted?
Oh, inflation, no. You're really, what we're talking about here is maybe 0.1% on inflation here in the U.S. We're a long ways away from that happening. And again, we need to see oil move to around $125 a barrel for that really to be a material concern.
All right, and you mentioned the jobs report. February jobs numbers will be coming out tomorrow morning. What are you expecting?
So it's going to be a reaffirmation of the low fire, low hire American labor market. We think we see an increase of about 70,000, an unemployment rate of 4.3%. What you're going to see is another month of gains primarily in healthcare and private education, although we do expect to see some sizable downward revisions actually in the healthcare numbers in the January report. So it's going to be more of a status quo jobs report. I don't think anybody's going to make too much of it because we're all just going to turn right back to what's going on over the Middle East.
Do you think it'll have any impact on the Fed decisions in 2026?
Well, my sense here is that the Fed already was on hold till at least mid-year. It certainly doesn't make cuts easier when you have the sort of volatility across the energy space, but the Fed usually just looks right through these things and it doesn't alter the path of monetary policy. Now, what we're really looking at here is how long will the war go on? And will there actually be an effective closure of the Straits of Hormuz? If not, then markets will begin to throttle back and the Fed will begin focusing on what's going on here.
And while rates are likely to hold steady when the Fed meets this month, what questions will the central bank need to answer when it announces its decision?
Well, I mean, the first and foremost is what's their view on what's going on in the war, the Middle East and the war of Iran? How may that alter the Fed's reaction function? And then two, you remember before last Saturday, we were all focused on what does AI mean for the path of monetary policy? How quickly can productivity really add to that? We saw the productivity numbers, by the way, very encouraging. 2.8% year over year, 2.5% over the last 2 years, and 2.2% over the last 5 years. I mean, this is an unmitigated good thing for the US economy. We're able to do more with less, which allows us to reallocate investment dollars to guess what? Investing in AI technology to further enhance our efficiency and productivity. Economists love this number. I'm a card-carrying economist. And we'll want to hear the Fed talk about that.
Yeah, and traders were pricing in a rate cut in July that's now moved to September. Why do you think that changed?
Well, clearly the concerns about what's going on with the war. I had one rate cut on the books this year, and that was when I was expecting we were going to get a new Fed chairman in late May, early June. Now, I don't know that that's the case anymore. Senator Tom Tillis, the Republican from North Carolina, says he's not going to entertain anybody in the Senate Finance Banking Committee. So my sense here is that we may not get that new Fed chair till next year. That would just likely push off rate hikes.
All right.
Till later in the year, early next year.
All right, Joe Brusuelas, Chief Economist at RSM US. Thank you for joining us at the New York Stock Exchange.